Last Friday marked the biggest down day of 2025. How was your portfolio holding up? Were you stuck holding bags? Did you cut your losses, or did you scoop up the dip? When the market tanks, most traders lose their cool, but should you? In this episode, we break down what market risk really is, why it's not what you think, and how you can position yourself to stay ahead, no matter what the market throws at you. The following are excerpts from Teaching You How to Trade, 108 Lessons. Lesson 26, How to Avoid Market Risk. Originally written by Master Chan. Before we get into the nitty-gritty of weave zone analysis, let's cover this chapter first. Quick note, this isn't some vague sidestep around market risks, it's a deep dive into the core of what's really driving things. First question to tackle. What exactly is market risk? You can tag it with all sorts of labels: policy risk, systemic risk, trading risk, liquidity risk, operational risk, and so on. But if you're looking at it from a pure technical perspective, it all comes down to one thing: price movement. Every type of risk, no matter how you slice it, shows up in how prices move. Volatility captures it all. Take a stock with a crazy high P/E ratio that keeps climbing. From a technical standpoint, you don't waste time on the P/E debate. Risk is what the chart tells you, plain and simple. At the end of the day, all risks funnel into price fluctuations. Now, my theory hinges on one big assumption: whatever you're trading needs to stay tradable for a foreseeable stretch. Imagine you're working a stock on the daily chart, and it stops trading in a week. Game over. The whole approach falls apart if the ticker can't keep going. But switch it up, say you're trading on a 1-minute chart. A stock halting next week? Manageable. You can handle that risk with tight technical control. The real problem comes when trading stops out of the blue, no heads up, just gone. That's the one flaw my system can't cover. It's the ultimate technical roadblock. My theory isn't foolproof, it has its limits, and sudden halts are where it stumbles. If trading stops, or gets cancelled entirely, the foundation vanishes. Here's the flip side: as long as trading keeps running and trades settle, my theory has no gaps. When using it, the only risks to watch are: will it stay tradable? Will it count? If a ticker's about to shut down, forget the theory, take your chances elsewhere. Suspensions? No issue, they don't throw off risk management. Every other risk ties back to price action. As long as the chart keeps moving, not cut off for good, my theory has it all under control. That's the key you need to lock in before applying it. There's another piece to this: cash flow. Trading doesn't happen without money on the table. If your capital has a deadline, you've built a stop into your own game. That's a trap too many traders fall into, running out of funds or overextending until they're done. The best money has no expiration. If it's got a limit, make it long enough to work with. It's a critical factor. Short-term funds? You'll need to shrink your trading timeframe to keep the risk in check. It's not ideal, but it's doable if you're stuck. Better to avoid that situation altogether. People often ask, what about bad earnings or unexpected news? It's not a big deal. Even in advanced markets, those impacts hit the price early. Here in China, someone always knows ahead of time. You're in the dark. Doesn't mean others are. It's all baked into the chart before you catch wind. By the time it's public, you're behind. Price movement is the only thing worth watching, money shapes it. This is a capital-driven world, cash builds the path. What's more dependable than that? Fundamentals, news flow, all of it rides on money. Focus on the trail it leaves. Step back, markets are just money trading for stocks. Stocks are paper tickets, nothing more, until they turn your cash into a bigger stack later. All the talk about fundamentals or value. Distractions. Stocks are a tool to flip one amount of money into another over time. If you're using my theory, get this straight, your cash only cares about tickets that grow it. Picture a machine where you drop in $1 and pull out $1 trillion a second later. No one would bother with stocks. No such luck, so we play the market. Don't get attached to tickers, your skill and timing bring the gains. If a stock's driving you, you're missing the point. Risk is straightforward, you put money in, and it doesn't grow, or worse, shrinks. That's the only risk that matters, everything else is noise. Any trade above zero cost carries that possibility, it's part of the deal. How do you eliminate risk? Negative cost. The top-tier trader, the one who never loses, can turn any ticker's price negative given enough time. That's what my theory's all about, taking any asset, any price, and driving its cost below zero with patience. Market goes up, down, it's all opportunity. Skilled traders play both sides, buy low, sell high, keep it moving. Too many stick to one direction, bad habit. For me, every sell entry point's a sell, every buy entry point's a buy, I just adjust the size. On a 1-minute chart, I might offload 50k shares, pick them back up cheaper, $4k profit after costs. Small? Sure, but it covers expenses and trims my cost. Even a tiny fraction of a drop matters. On a daily chart, it's bigger moves, bigger positions, millions of shares if it lines up. Anything costing more than zero? I don't trust it, goal's always to push it negative. Same with warrants, had one climb to over $1 near the end, sold it all. Cost was negative 2.8. Kept the position steady from the start, sold high, bought low, no extra buying. Just rode the waves. Picking stocks? Not the focus. Look for volatility, that's the edge, but it's hard to predict, like guessing tomorrow's weather. Smaller traders can go all in, switch between tickers, max efficiency. Big funds like mine can't move that fast, takes time to build positions. I target monthly or weekly buy entry points, later entries, not the first wave. Jumping in late avoids stretching out the process. I'd rather nudge the big players into selling cheap than scrape shares from retail. They don't like me, I'm the one profiting off their moves, no matter the direction. They're stuck playing my game. Solid cash reserves plus mastery of my theory? That's the winning combo. Market risk? Barely a thing.
If you're interested in refining your entry points and targeting profit zones effectively, make sure to subscribe for more price action trade breakdowns.